thank you very much for agreeing to chat with us. First of all, could you just introduce yourself and tell us a little bit about your background in respect of Fair for You, which you work for, and affordable credit.
Good morning, Josh. So I am James Wilkinson. I am Head of Lending and Credit Risk and currently the Interim CEO at Fair for You. I have been here since April 2019, coming across from a near prime lender and before that from a building society. With a background in credit risk, I was brought in to build a robust lending strategy to find a way to market to the demographic that Fair for You tries to serve. A bit of background on Fair for You. So the business is now about 6 years old, backed by a number of social investors such as Big Issue Invest in Scotland, Joseph Rowntree, Esme Fairbairn. So there's about 9 investors all in all, and more recently Fair for All, the government-backed lending arm, which is trying to put money into the right places for lending to the demographic that we try to serve. So, and on that demographic, we are very much looking at subprime demographic customers who have real difficulty accessing mainstream credit and have in the past had to pay poverty premiums for any goods that they need. We have relationships with Hotpoint Whirlpool and Dorset Home Stores as our main suppliers. So we insist that anyone applying for credit with us takes out the loan to buy an essential item. So that there is no misappropriation of funds. But our demographic is primarily sort of females 25 to 40 with dependents, very much benefits dependent income. And they're in need of washing machines, cookers, very, very white goods, all the essential things that that previously they would have had to maybe go to some of the predatory lenders on the high street, for example, the Bright Houses of this world that Fair for You was really set up to try and tackle. Now, as we move on to talk about the market, I mean, those lenders of them have contracted significantly or closed completely in the example of Bright House. We found that the market has really come towards us. Our numbers have doubled in the last 12 months. So really significant growth as the market's contracted elsewhere. And similarly, actually, due to some of the changes we've made with our strategy, our bad debt rate has also dropped quite a lot as well. So we really have hit the demographic that we were set up to try and serve.
Does Fair for You, in addition to facilitating purchase of white goods and other related things for people who would otherwise find it quite difficult to do so, does it also help to build those individuals' credit scores? Is that part of the role that you
Absolutely.
perform?
Yeah, absolutely. So there's obviously the need to alleviate the paying the poverty premium so customers can get goods at an affordable price with a flexible payment schemes to suit them. But part of it is about the chance to improve your credit file. We do report fairly to the credit bureau. If a customer stays on plan, then we will mark it as such, and it's a chance to improve. We do have a really good returning customer base. So they will come once they've taken out one loan, they will come back because they know that they can get borrowing from us. And so you'll find that we offer slightly more quality of living goods to returning customers. So we do offer electrical items for good payers. And we have a shopping card that's we've started last year, which gives customers flexibility to go to various stores.
What is your impression, therefore, of the market for affordable credit at this point in time? You've alluded to it already in your introduction, but it would be just useful to get your sense of how you would characterize the market now.
I mean, there is no doubt there has been a significant contraction in the last 12 to 18 months. We get some data from our credit reference agency that we use, and they are showing a significant drop in the high cost short-term credit sector. And that is whatever, we're seeing exactly the opposite with us. So more customers have come to us. So whereas we're going up the curve, the market's contracted. So we are benefiting from that as a business. What is of concern is, where are those customers going? I don't think the need to buy these items has gone. So if they're not coming to us, where are they going? So as I'm sure you've seen in the media, the FCA have released the Woolard report recently, which is going to try and combat some of the unregulated lending in the high-cost short-term credit sector, which I welcome. I think the regulation's needed there. I think there's also a lot of lending that we don't see. So doorstop lending perhaps is on the rise again. Things that, we just can't measure. But I suspect is going on, because I don't think the demand for these products has gone away.
Yeah. So what do you think the market should do, and players such as yourself and other players within the fintech sector and wider financial service sector should do to improve their product offerings, to bring people who are maybe being led in that direction back into the fold of sort of better backed services such as yourself?
From our experience, the problems are reach. It's just very difficult. There are people in the business, in the sector, with deeper pockets than us. So it's very much, we would love to do so much more, but it's reaching that demographic. Very difficult for us to do. A lot of our marketing is very much done on Facebook, which has been successul, but it does get to a state of diminishing returns. We need to find other areas to reach the demographic and get to them before as I said, a predatory lender does.
Is there anything that regulators can do? Is there a role for policy in this area that would make it easier for you, but also easier for other players as well, to improve and increase the number of offerings for people?
As I said, I'd love for some of the government bodies to advertise what we do and why we are a good alternative lender for our demographic. And as I mentioned, the Woolard review, I think, is going in the right direction around tackling the buy now, pay later sector, which is increasing, albeit a lot of unregulated side of it that ought to be brought in under the regulatory arms of the FCA. I think there are other things I would like. We pay a lot for our credit bureau services, I think, a cost per call basis than some of the big banks, because we don't have the economies of scale. I think there could be some benefits we would get there if the government would subsidize, for want of a better word, for those that are lending with a social mission or objective or principles. And I guess the other thing that I guess the government gets involved with is the open bank piece of work. I seem to attend endless forums on open banking, and it's very confusing. So I'm not surprised it's confusing for customers as to the benefits of that and what we can do there. There seems to be no real standard approach to it, and it's still very, very much in its infancy. But I get great comfort out of seeing the customer's income and being able to verify that, because quite often a lot of lenders in our sector have fallen foul of the FCA on affordability calculations. Well, what better way to establish affordability than through a customer's bank statements, where you're seeing income and expenditure real time, as opposed to a credit bureau that sometimes you don't see the full picture.
That's really interesting to say. The open banking angle on affordable lending is actually quite key, particularly for players like yourself. Yeah. Whereas, of course, it's being exploited by a range of other fintechs doing stuff that isn't really focused in the social impact and the affordability sector at all. So that's quite a unique insight that you've offered there, which is very helpful. What's your sense of the outlook for the market? Your sense of confidence in terms of your ability to play in it, others as well. And it's the likelihood that it will grow or shrink or whatever. What's your sense there?
Yeah, I think the signs are it will grow again. I think the demand is there. I think a lot of lenders the demand is there. The supply has dried up. In terms of what we do, our core offering is strong. The white goods is absolutely what we're here to do. That is totally core to the mission. And I mentioned earlier the quality of living through the shopping card that we do. We've also recently piloted a food club, so very much a hot topic around food poverty. So we've got a partnership with Iceland Food Stores, which launched in October last year in 2 of their regions. Is looking really good, and it's just around holiday time food poverty, where school meals aren't being provided, and so a customer can has a reloadable card where we give them, put £100 on that card. They can then go and do a big freezer shop, and then they can pay it down with using their benefits payments during term time, and then go and load it up again, do another big shop. So it's early days with that, but Iceland are very much engaged with us on that one. I think that's an interesting innovation for us, and to see how those loans perform, but feels like absolutely critical thing to be doing at this time. Other products or variations that we like to get into a bit more, we want to do more around home computers and laptops. Again, very much a hot topic at the moment, to provide access to our demographic who probably don't have all that they need to do homeschooling. So we are trying to switch that back on for new customers. Historically, it came with risk, flight risk, but if we can mitigate the fraud risk, then I'm going to try and switch those back on in the next month or so. And I guess the other thing that we've thought about a fair bit is Energy Club, helping people with paying their bills for fuel. But those are kind of early stage thought process at the moment.